Welcome to the Private Practice Survival Guide podcast with your host, Brandon Seigel. I'm a published author, speaker, entrepreneur, and private practice strategist dedicated to transforming the way that healthcare functions. This podcast is all about empowering you to create the change you want to see. Let's dive in. Welcome back. In this episode of the Private Practice Survival Guide, we are talking about one of my favorite topics. What's that topic? The ABCs of employee compensation. I know many of you are rolling your eyes, but I absolutely love this topic. And I love this topic because it's a topic that people treat as it's so stupid simple, and yet it's not. It's so complex. The complexity comes down to there's compliance, there's labor, there's what you can afford, there's what's the actual total expense on top of all of that, what that comp package looks like, how someone feels about it, the stability of it or the instability of it, the way it makes your employees feel. Like I can make an employee feel valued, or I can make them feel like a turd, literally by the way that I structure my pay. And so there's so much to this. And what I hate is when you ask me, how do I do it? I'm like, it's a process. It's a process, it's an evaluation, and it's evolving. And part of it comes down to your philosophy, your labor regulations, the way that your organization functions. But today we're going to break out both some of the compliance factors of it, but also the way that we evaluate how much to pay someone, the way we pay someone, when we pay them, all those different things. So let's dive in. First thing, compliance-wise, I want to be crystal clear. We've got an employee, which is a W-2 person. They are a W-2 form is used in the United States by employers to report wages paid to employees and taxes withheld from them. That is an employee. An independent contractor is classified under a 1099 form. This is a series of documents used to the United States to report various types of income other than wages, salaries, and tips. I want to be crystal clear. If you're in private practice and someone is consistently working for you day in and day out, and you control their environment, and you have them as an independent contractor, I challenge you here and now that you are misclassifying them. The healthcare industry is ruining the condition of compliance. And the reason is it's cheaper. But by law, if you really look at it, most of our people should be employees in healthcare. And we say, well, why does an employer want it to be a contractor? Because you want to save money. You don't want to pay all the taxes and all the other stuff. Why does an employee want to be a contractor? They don't want to pay money to Uncle Sam. They want to write everything off. The IRS wants every dollar. Either you're paying for it or the business is paying for it. But someone's got to pay for it. And what I want to say is that it's really important when you're looking at your employee versus contractor side that you're measuring. And so typically an employee is someone that you control. You tell them how to do the job. They're paid hourly. They may be paid salary. They're using employer materials such as your EMR. They are typically working just for you. They have a continuous relationship. So it's at will or a defined term, but it's continuous. The employer decides manner and means of performing. You're coaching them, you're educating them, you're teaching them, etc. The employer determines what work they should perform. Typically, an independent contractor is like a landscaper, a pool person. A medical billing company could be an independent contractor because they make all the rules, control everything. They're paid upon completion of whatever that project is. They have to provide their own materials in most cases. They work for multiple clients doing the same thing, not someone that is an employee full-time and picking up 5 hours of side work. That's a per diem W-2 employee. So if you tell me that they have a full-time salaried position and they're picking up a little bit of work with you, that is a per diem W-2 employee, not a contractor. Contractor decides the manner in which the work is being performed. The contractor and client agree to the project scope. And so it's really important. And so I keep seeing companies, and I want to be transparent. I've looked at 3 practices in Florida in the last 90 days that are for sale, and they are not selling because their workforce is all independent contractors. There's no value to a practice I'm buying if it's just independent contractors. So when we're buying a practice, and not that this is the topic, but one of the things we're buying is workforce, employees. So as we look at employees and we look to value our business, how we structure the pay of our employees is so important. So here are some other things I want you to be aware of. All W-2 employees must be classified as either exempt or non-exempt, according to the Fair Labor Standards Act. Exempt employees are not entitled to overtime. They are usually paid a fixed salary and meet certain job duties or criteria. Common categories of employees that are exempt include executives, professionals, administrators, and certain high-level sales employees. And when we talk about like administrators, that's usually managers. So I want to be crystal clear. IRS does not like exempt employees because they feel that they're losing out on tax revenue because they're not collecting overtime. So you can have a non-exempt employee still have a salary. A non-exempt employee is entitled to overtime pay. And that can be 40 hours a week, over 40 hours a week, or in some states like California, over 8 hours a day is overtime. They're typically paid on an hourly basis. However, they can be salaried, but if they are salaried, you still must pay them for overtime. And so non-exempt employees must be paid at least the federal minimum wage and receive overtime pay at 1.5 times their regular pay, and it can increase, etc. Very transparently, our physicians, our clinicians that do not require direct supervision and have free licensure to treat, like a physician, like a physical therapist, those are 2 examples that would probably fall under the professional designation if you decided to do an exempt employee. But if you have an assistant, such as a nurse practitioner, a certified nurse assistant, a occupational therapy assistant, a physical therapy assistant, a speech language pathology assistant, they will not qualify under the exempt employee as a professional designation typically. So that's where we got to make sure if you're going to use exempt employees, you qualify them. Again, why? So the only reason you should be exempting employees is if you are demanding someone to work overtime and you don't want to pay them. Otherwise, there's no reason not to have a non-exempt employee, plain and simple. So a lot of the times you're making like your receptionists and these other people that are not qualifying as salaried. And I come back to, so in my organization, just so you know, 95% of my employees and even my managers are non-exempt hourly. And I've had employees that average 15 to 20 hours of overtime. And you know the difference? They value the overtime, and I justify the overtime. So they feel their time is valued. The only reason why when someone says, well, I want to be exempt salaried, is 2 reasons. One, they want to know what they're going to get paid, and they're afraid that for whatever reason, the non-exempt is not, stable, which is wrong. Or they want the ability to get paid and do less work. When I audit practices, the number one reason why I find employees' ratio of pay to revenue is low is because they're exempt salaried. Those that are tied to performance expectations on an hourly basis thrive. And so when I'm looking at creating compensation and all of that for employees, the first thing you need to figure out is you have to understand the total people expense. So the total people expense is the gross expense connected to all facets related to people requirements to operate your organization. The easiest way to categorize expenses is what expenses are directly correlated two employees and change. Wages, taxes, benefits, computer, software, payroll, EMR, liability insurance, workers' comp insurance, any clinical tools that increase and decrease based on that, any kind of tools, resources that they get, that is all under our total people expense. Imagine if that expense, so I say it to you in this way. If I were to come in as a contractor, I would bring all my own tools, my resources, my everything. The only thing that could shift is if you need me to work out of your specific EMR. But when I hire a cleaning company, as an example, as an independent contractor, not an employee, they're bringing their own cleaning supplies, they're bringing everything. So I want you to imagine, if you hired an employee who was a cleaner, her total people expense would be wages, taxes, cleaning supplies, everything related to that employee. Just like if I were to outsource it to a contractor so I can get that equivalent. And so total people expense is a very important category. It is one of the biggest KPIs we should be measuring. And so when we're looking at that, we're looking even at our expense to revenue ratio. We're looking at the productivity pay versus the indirect pay. We're figuring out all the different nuances of PTO, holidays, cell phone, mileage, continuing ed, medical, dental, vision coverage, any kind of retirement, any kind of reimbursements, employee taxes, work comp, liability, software, etc. And so I actually look at what percentage of total people expense above wages. And I find that the average organization is somewhere between 18% to 34% above wages. That's very important for you to recognize. So when you're paying someone $25, there is a reality that they're costing you 34% above that to make up their total people expense. It's really important that we break that down, because eventually we're going to do that revenue ratio to say, what is our total people expense to our revenue? Hint, hint. We want our total people expense, every single people expense in your organization, to not exceed 60% of the revenue you generate. That total people expense, again, benefits, paid time off, holiday pay, EMR, software, work comp, liability. You get where I'm going with this. If you're struggling with this, I'm telling you now, reach out to me. It's going to cost you money, but we will dial you in. And I know how to do it in a way that aligns with the business algorithm. And that's what you're missing. You're creating compensation based on empathy instead of compensation based on strategy. So, really important, I'm going to repeat this again. There is no such thing as a private practice that can survive under 15% net profit margin. You must have at least 15%. In order to make sure you have at least 15%, your total people expense must be 60% or under. That's admin, that's therapists, that's physicians, that's everything, okay? Then we have our total facility expense. That total facility expense is 10% or less. So if I add up our total people expense, our total facility expense, that's 70% of our revenue. If you don't spend your total facility expense 10%, you can throw the remainder over to your people if you want. So if you're a home health company and you have absolutely no real estate, then yeah, you may have a total people expense up to 70%. Now, when I divide up that total people expense, typically of the 60%, I'm being honest, 10 to 15% should be admin. The reason why practices often are struggling is they're too admin heavy. So I want you to think of it in this way. If more than 15% of your revenue is connected to the total people expense of your admin, we got to relook at that. We got to re-examine that. And so when we're looking at our strategies for success with comp, we need to understand our business algorithm. This is your recipe that creates your business financial outcome. We need to identify your ideal scene in mind. Profit first mentality. Identify the goals and objectives. We need to identify your employee's ideal scene. Risk, reward, responsibility. How much do they want to work? How much do they want to make? how hard do they want to work? How much risk are they wanting to take on? So I want to be crystal clear. The more risk that an employee wants to take on, the more they can make. So I say it in this way. You want a safe play? Here's 60K. You want to take risk? Here's 100K. Let's play. Like that's where my mentality is. I give up more margin the more risk you take on. We want to discover and track your trends through KPIs and metrics. We want to get team buy-in. So we create a game board. We gamify this. We create what is expected. What is your minimum expectation to be successful? What is your ideal expectation? And how do you make the next level of money? What does that look like? So I always say, if you're not creating a 5-year comp structure, it ain't going to work. And one of the things I say is, don't give them what you're giving. Understand what they want first. So recently, I was hiring, and very transparently, the role was 18 to 20. And one of the things I asked was like, what do you want to make in the next 3 years? And when they're going over $20, unless I see a skill set that would allow me to provide them that opportunity, I kindly explained to them that they should look at alternative functions because they're signing up for jobs that don't have the fuel to get them where they want to go. So I say it this way. If you only have $40 for gas each week, why are you going to buy a diesel pickup truck? It's not going to go far. So you got to figure out where they actually want to get to so that you align them with fuel that gets them there. So this $18 to $20 an hour job, this is like a high school job. This was not meant for someone, but these people who are out of work are looking for anything. And what happens is they compromise and then they resent the fact that they're stuck there. So I'd rather coach them on how to get where they want to go versus allowing them to stay complacent. One of the things that we want to do is we want to craft a review timeline. We want to know when to pivot. We want to make sure that we are calibrating so that you're not stuck in the weeds, so that you're reviewing compensation metrics, goals, and objectives. Every single employee must have a roadmap. Every single employee must know where their ceiling is and what contributes to growth beyond the ceiling. What are you hiring them to do? What does that look like? And when we're looking at compensation, I also look at what their love language is. And I know that sounds funny, but like, how can I make you feel valued? So if I'm going to say it this way, if my wife said the only way for me to make her feel loved was for me to buy her really nice stuff, I would say I'm not rich enough to be your husband because I won't have the financial capacity to showcase how much I love you. Straight up. So understanding, do you have the financial capacity to show them how much you love them, how meaningful they are to your organization based on what they define as their target compensation goal? And so my belief system, I believe exempt status is a huge risk today. Most don't recognize they are misclassifying employees. Most employers are utilizing exempt salary. They're not recognizing the financial liability and understanding that they can build stability with a non-exempt hourly role. The only difference is now I have accountability. Every hour you work has an expectation. So unless you reside in California, then 99% of the time we may do not exempt roles based on the 8-hour reg, but it just depends. But most of the time I'm going non-exempt. And I want to be clear, there's this idea of like pay for performance. We can pay them for all their time. We can value all their time, but we're going to structure an expectation for the time we're paying for them. And then we're going to give them incentives to say, hey, you have this opportunity to generate more revenue. And when you do, I'm going to profit share with you. So the more that we create together, the more you get to keep. Plain and simple. How do we want to do that? So when employees say the word salary, they don't understand exempt, non-exempt. All they're saying is, I want $100,000, Brandon, and I want to know it's guaranteed. So here's what I share. I'd rather us talk about earning capacity, earning potential, earning responsibility. If you prefer, here's $100,000 with no expectations, I'm not the person for you. But what I tell you is this. if you want a salary, then I'm going to make you work 50 to 60 hours a week. If you want hourly, then I'm going to give you the opportunity to work 50 to 60 hours a week. Which one feels better? So if you just want to work 40 hours a week, then here's your stability. Here's your hourly pay. Let's make it happen. Let's go right. And when and if you want to make more, and everyone thinks overtime's a bad thing. Overtime's not bad if you have revenue and justifiers to it. So I say it this way. I have a need for 5 hours a week of support in my HR department. And I have someone that is full 40 hours. But it would actually be cheaper for me to pay her time and a half to work a 5-hour project per week, and she'll value it, than for me to hire a part-time W employee for 5 hours a week. Plain and simple. And I'll get a better product. And so overtime, I create accountability on what that overtime is worth, meaning what are we doing with the time? How are we spending it? Where do you want to do it? And how do we justify it? But very transparently, my rule is any overtime is justified overtime. You want to work overtime, take on more responsibility. Plain and simple. So let's talk about these different structures. We've got exempt W-2 salaried. This is an employee that's guaranteed a salary and not eligible to overtime. Recognizing in some cases, if they come in to work for you today and they work 1 hour and leave, you have to pay them for the full day. That's part of the exempt salaried requirement. It's a higher risk structure from a compliance standpoint, and you often can have loss leaders of money if you're not careful. The other thing I find is more salaried employees are burned out because employers are driving so much production on them. Non-exempt W-2 time-based hourly employee. This is an employee that gets paid at the same rate for every minute worked. They're eligible for overtime. They would be subject to any rest break requirements based on labor regulations, but you can still guarantee them the opportunity to work 40 hours. It's not a salary. It's, hey, Jim, here's the deal. Your schedule's 9 to 5. You get paid for every hour you show up. I'm going to guarantee you 40 hours of work. Just show up. Well, what if I don't show up? You don't get paid. Well, when I'm salaried, if I don't show up, I get paid. And I say, if you're salaried and you don't show up and you get paid, you get fired. So it won't work. So non-exempt W-2 hybrid hourly employees, that's another thing. So hybrid hourly is when I take two different rates and I say, I'm going to pay you for every minute, but your clinical time is going to be worth this amount and your indirect non-clinical time is worth that amount. And we are prioritizing the revenue generating time in that model. And then the other option that some do is a non-exempt W-2 global reimbursement employee. This is where we say, hey, I'm going to pay you $500 and that's going to cover all of the following, and that should be about 8 hours. So you're getting a $500 day rate and that should take everything for you to get done. A little bit riskier from a labor law standpoint. People call it a fee for service. It's more of something we see on an independent contractor basis than an employee basis. But there are employers that do that. And you just want to make sure that you create talk to me if you want to do that, because there are certain labor stuff that you should have in place if you're going to do that. So the other thing I want you to recognize is defining the difference between total people expense and the global wage equivalency. And right now we're talking about healthcare practitioners, revenue generating employees. So the total people expense is the overall expense for an employee, inclusive of all the expenses, etc. Global wage equivalency is basically when we say, hey, I paid them for 8 hours. They did 5 hours of revenue generating time. We divide that by 5 hours to say, this is the cost per revenue generating hour, almost like a fee for service, just to have that global wage equivalency, just so we're clear. And so as we're looking at this, we're building different things. And sometimes what I'm going to do is I'm going to factor in. So I've got a 31% additional expense. So when I'm looking at your package, I go, hey, Jim, I'll tell you what, you're going to make $62,400 this year if you show up for 48 weeks, 40 hours a week, and I'm going to give you 4 weeks of PTO that will make it $62,400. $30 an hour is what that's worth. That's the bottom line. On top of that, you're going to have another 20% in benefit. So we're looking at, it's about a $75,000 total benefit package, like total comp package. This is how we break it down. This is the way it is. You're averaging, based on your production, you're going to cost me about $55 for every billable hour, and I'm only getting $75 per billable hour. You're taking the majority, too much revenue in this circumstance. But I'm giving an example, but that's how we start to crunch numbers. We start to generate a relationship that they understand that their financial value is directly correlated to the financial revenue they generate. Their employment value is based on the quality of what they generate. I cannot, just because someone's incredible at what they do, so I'm going to say it this way. You want to get your hair done, okay? One dresser can get your hair done for $40 and it takes an hour. And another one can get your hair done, but she's going to take full 8 hours because her quality takes 8 hours. And now she's charging you $320. You're going to choose the 1 hour. You don't have 8 hours to give up of your time. So recognizing, like, the more revenue you want to generate, like, at the end of the day, that's what allows affordability. That's what allows you to get to that level. And so it's really critical that we're looking at this when we're building that out. And so when you communicate your numbers, we want to do it with conviction, authenticity. We want to showcase potential. So I come back to that Jim. Jim, I want to give you an opportunity. I recognize that you're looking to make around $70,000. I don't know if this role is right. Your base level is around $62,400. I'm going to give you overtime opportunity to make up to $85,000, but that's overtime. And I don't know if you want to put in those extra hours. So our overall package is around $75,000 before the overtime. The overtime would put this package up to $100,000 in value. Here's how it looks. This is what we do. We do an annual retention bonus. That's how we acknowledge your retention. Our benefits and PTO increase year over year. And we do a profit sharing based on the success of our company. But your cap and ceiling would be at the 62 base with the $85,000 based on overtime. I understand there's always going to be someone who's going to pay you more. You have to see more in the company than just the numbers. And so that's really important. But here's the other thing. Do you remember those books, Choose Your Own Adventure? I loved those books. Now, if you don't remember and you've never read one, I want you to pick up a Choose Your Own Adventure book. And the idea was you're reading this book and it's like, if you want Jimmy to go scuba diving, go to page 35. If you want Jimmy to get eaten by a shark, go to page 15. I loved the ability to choose where that adventure went. Imagine if you were able to choose the employee's adventure. They were able to do it. So what if I said to Jim, hey, Jim, I got 3 options for you. I got your $75,000 salaried role, okay? You're going to be in 50 hours a week. That's one option, okay? 50 hours a week, not a minute less. That's the job, okay? I've got an hourly role that's $62,500 guaranteed with overtime potential to $80K. And I've got this other thing called a hybrid pay. And you're going to get $55 for your billable time and you're going to get $20 for your indirect. But if you produce what you're producing in the other levels, you're going to make $95K. A little higher risk. You got to make sure certain ratios, but you get to choose your own adventure. And 90 days notice, you can switch to any of them. Now the employee feels like, okay, I can make 95, I can make 85, I can make 75, I can make 65. Got my options, my choices, etc. What if the employee comes in and says, you're like, look, you need to see 35 patient hours to make what you want to make. They go, well, I don't want to see 35 patient hours. You're like, okay, so how many patient hours do you want to make? I want to see 20. Okay, this is what 20 pays. And if you want to increase it, we'll create a bonus system. So when you feel like earning more, you can earn more. There's so many ways to slice it, dice it, etc. The same thing with, what if they don't need benefits? So anyone that doesn't need benefits in my company, we give a $2 hourly increase automatically. What if you just gave that? What if you said, if you don't want these benefits, this is the value trade, provided you know if you ever want them in the future, you'll reduce that. Something I want to remind you is the more risk employees take, the more margin I give up. Incentivize earning potential based on risk they take, because then they hold ownership to it. So pick your adventure. I kind of gave it to you, but I'll say it again. Exempt salary, 65K pay structure. Non-exempt hourly, 32 per hour plus bonus. They're going to earn up to $81,560 in non-exempt hourly. Non-exempt hybrid pay, 50 per billable, 18 indirect. Now they're earning up to 87,000. So we went from 65 guaranteed to 81 earning to 87,000, depending on. And what was interesting was I did give up more margin, but not substantially. But their earning potential was far greater valued when they took on that risk. So when we're looking at that hybrid rate, the idea is revenue generated time versus non-revenue generated time. Then we come up with a PTO rate and a global wage equivalency rate. And so these are all things I can do for you. I'm just kind of giving you that background. But the key is how I present it. The transparency, the earning potential, the opportunity, and that they have control. They have control to shift, change, and they are in the driver's seat. Very important. They get to flip to that page. They get to make that choice. And with administratively, I'm going to give you an idea. So one of the things that I'm seeing is we are not utilizing administrative employees for what they can create. Imagine if I took every single employee and I said 50% of your time you're generating revenue. You're going to be teaching yoga, you're going to be fitness, massage, red light specialist, nutrition, meal planning, baseball lessons, whatever. They're making more, they're covering their cost, and guess what? They're not just dialing for dollars for scheduling. We got to look at things differently. So even the way that I structure administrative employees, I want to shift from a 40-hour-a-week administrative employee to like a 25 or 30 and offsetting it with revenue generating potential. So we'll create bonuses, we'll create structure. And one of the things I need you to recognize is when it comes to revenue, we need to identify who we're trying to attract. So I had this client and she's like, Brandon, I'm losing money. And I'm like, why? She's like, well, I'm paying my therapist too much. And I'm like, you're not paying them too much. They're not performing. And I said, why are they not performing? And she said, well, I don't get it. I'm trying to create the most inclusive, supportive environment. I'm giving more PTO. I'm doing less productivity. I'm doing all this. I go, you've attracted the pasture horse. You basically said, hey, come work for me and you don't have to work. Literally, that's what you said. So that's why I'm like, any company that uses their marketing aspect of work-life balance, define what that means. Define what work-life balance is, because when I ask the interview question, if I gave you $1 million tomorrow, would you work? 97% of people say no. They'll travel the world, they'll watch YouTube, they'll go swim with sheep. I don't know. They'll do crazy things. But sometimes the marketing to our employees is attracting the wrong type. I want you to attract racehorses. I want you to attract people that are game changers. I want you to attract people that say, before I die, I have to do something with myself. Because that'll create change. It will. And so when we're looking at clinical leadership, that's the other thing. We often lose by too much management. Make sure your leaders are covering their cost in revenue generating time. Do not allow yourself to have a leader that does not generate enough revenue to cover its cost. Your practice won't survive. It's really hard. It will survive, but it's hard because you're stealing from other therapists to pay for that. And so breaking down also the percentage of expense above wages is really important, and understanding that we can get creative with benefits. So sometimes what we'll do is we'll say, hey, you can choose from all these benefits, or you can take a $14,000 benefit in which none of those benefits, you just say, I want $14,000 in wages instead of those benefits. There's plenty of ways for you to get creative. So you got to sell your compensation package to your employees to get buy-in. If your employees want the following, this won't work. endless earning potential with fixed rate of productivity, more work-life balance with increased wages, more wages with stagnant production, more wages with reduced reimbursement, more benefits, more PTO, more CEUs, stagnant revenue. Bottom line is we can't increase the honey without increased money. So, creative compensation, we got to understand our employees' financial needs. We got to understand their wants, their desires. We need to know how hard they're willing to work. We need to know what their responsibility level is. What are they willing to take on? What are they willing to ensure? What is the most meaningful thing to them? And what is their risk tolerance? What role does benefits play in their financial goals? And so compensation is equal to affordability. Employers must find employees' love language. Build a culture that attracts your retired racehorse and offer creativity in the way that you compensate. Showcase growth trajectory, create the 5-year plan. Understand your business algorithm so that you know what you can afford. Did you know that 76% of small businesses with performance-based comp structures, including reward-based incentives like bonuses, reported a 15% increase in employee productivity compared to those with fixed salary structures? That was done by World at Work Salary Budget Survey. So, inspired by the great Richard Branson, fair and inspiring compensation fuels your team's passion. Reward their efforts generously to build a thriving, unstoppable business. Thank you for tuning into this episode of the Private Practice Survival Guide podcast. Don't forget to like us, subscribe, share with your friends, and reach out to me at Brandon@wellnessworksmp.com, because together we can thrive, not just survive. Thank you for tuning in to the Private Practice Survival Guide podcast. I'm incredibly grateful to each and every one of you. Exciting news. We're now available everywhere, from Spotify to Apple Podcasts to YouTube or anywhere you like to listen to your podcasts. So watch, listen, and reach out. If you loved this episode, please drop a 5-star review. It truly means the world to me. Are you looking for more ways to elevate your practice? If so, now is your chance. Reach out, go to my website, or email me at brandon@wellnessworksmp.com. And remember, it's not just about surviving, it's about thriving.